Hey, and welcome to the deep dive. We're kicking off something pretty fundamental today, looking at the very core of what businesses actually do.
That's right. We're diving into Unit 1 of your IGCSE Business Studies. Specifically, we're focusing on the business activity section. Think of this as, well, part 1 of our exploration into this really key unit.
And our mission today, to really get to grips with two essential chapters. Chapter 14, which is all about how you measure if a business is doing well, succeeding.
And Chapter 15, which tackles the often harsh reality of why businesses sometimes fail.
Yeah, and understanding these two chapters isn't just about, learning definitions, is it?
No, absolutely not. It's vital. It really builds the foundation for your analysis skills as Assessment Objective 3 AO3. It's where you learn to figure out why things happen in business and sort of what the consequences are. These chapters, they give you the tools.
Exactly. We're going to pull out the most important nuggets from your sources on these topics. And just a heads up, you can always find more resources, dive even deeper over at www.igcs-business.weebly.com.
Yeah, definitely check that out. So our goal today is really to break down these key concepts from the unit, help you revise them, and crucially, see how they fit together.
Okay, sounds good. Let's jump straight into it then. Chapter 14, Measuring Business Success. I mean, it seems obvious, right? Are you making money? Simple as that.
You'd think so, wouldn't you?
Mm.
But the source material makes it really clear. It's much more nuanced than that. How a business knows if it's truly successful.
Hmm.
It's surprisingly complex.
Okay.
It's not just one thing. And it can be measured in loads of different ways, depending entirely on what that specific business is trying to achieve. Its objectives.
Right, so it's not just about the profit, the bottom line. What are some of these key ways businesses gauge success then, according to the sources?
Well, the sources highlight several key measures. Let's start with the one you just mentioned, revenue.
Right. The total money coming in from sales.
Precisely. It's the total amount generated from selling goods or services.
Mm-hmm.
It's often the first number people look at, and it gives you a quick guide, a sort of snapshot of activity level.
Like the Digi example here in the text. Their revenue went up 16.1% over 5 years. That sounds pretty good. Went from, 5.9 billion to nearly 7 billion Malaysian ringgit.
It certainly looks positive, yeah,
Yeah.
in isolation. But, like the source rightly points out, you've got to look at the context.
Okay.
Was that increase actually hitting their own targets? What were the general trading conditions like? Was the whole market booming or struggling? And critically, how did their rivals do?
Right.
If the whole telecoms market grew by, say, 25% in that same time, Digi's 16.1% might actually mean they're, losing ground, losing market share.
Okay. Context is absolutely key. Got it. What's another measure then?
Market share. This one's all about a business's size relative to everyone else in its industry. It's the proportion, the percentage of the total market sales that one specific business captures.
Okay, so like the fizzy drink example.
Mhm.
If 100 million bottles are sold and Coke sells 43 million, 43% market share.
Exactly that. And the sources point out that increasing your market share often means you're directly winning sales from your competitors, which is generally seen as a good sign.
Makes sense. Being the biggest player is usually better.
Usually. The challenge, though, as the text mentions, is getting reliable data on the total size of the market. That can be tricky sometimes.
Yeah, you need to know the size of the whole pie to measure your slice accurately. Okay, what about something less focused on just the numbers?
Good point. Customer satisfaction. This measure focuses on, are you meeting the needs and expectations of the people buying from you? Are your customers happy?
And happy customers often mean loyal customers, right? They keep coming back.
Exactly. A loyal customer base is a really strong indicator of success. It suggests the business is consistently doing something right. Businesses monitor this in different ways.
How do they do that?
Well, some have formal feedback systems. Others actively track what people say on social media, Twitter, Facebook, review sites, or they send out surveys, like Booking.com does after you stay somewhere.
Yeah, I get those emails.
And tracking those satisfaction levels over time shows if they're improving or maybe starting to slip. It's an early warning system, potentially.
Okay, so revenue, market share, customer satisfaction. And then, the one everyone thinks of first, profit.
Yep. For most private sector businesses, profit is definitely a core measure, a fundamental signal of success. Rising profits usually indicate the business is operating more efficiently, managing costs well, or growing sales effectively. Or maybe a mix of all three.
But again, I'm guessing context matters here too.
Absolutely. The source highlights this really well. Profit earned by a monopoly, a business with no competition. Well, That's very different from profit earned in a really fierce competitive market.
Sure.
And the sheer size of the business is a factor. You can't meaningfully compare the profit of a tiny local cafe to, say, a huge multinational corporation.
Right. And the text mentions something about comparing profit to the money invested.
Yes, that's crucial for a deeper analysis. Return on capital employed, or ROCE. It tells you how effectively the business is using the money that owners or shareholders have put into it. How hard is that money working?
Okay.
And a key piece of advice from the source here. When you are comparing profit, look at businesses in the same industry. A farmer's profit margin means something very different to an insurance company's margin.
Right, comparing apples with apples. And the sources also note that profit isn't always the number one goal, is it? Some businesses might just aim for a modest profit, enough to live on.
Exactly. Which brings us neatly onto growth. For many businesses, success means getting bigger, expansion.
And growth itself can be measured in different ways, according to the text.
It can indeed. By turnover or revenue, like we discussed the Lenovo example, $46.3 billion turnover in 2015. Huge number.
Wow.
By the number of employees, a simple headcount. Ford is massive by this measure. But the sources also show how employee numbers classify firms differently, like under EU definitions, Ergon versus Cresta Holdings falling into different size bands.
Right, those micro, small, medium, large classifications based on turnover and employees or capital.
Exactly. Growth can also be measured by market share, which we've covered, and by the amount of capital employed, the total value of money and assets tied up in the business.
Okay. And the text flags a warning about growth, too.
Yes, an important one. Growing too fast can actually cause major problems. It can lead to something called overtrading, basically, running out of cash because you expanded too quickly. We'll touch on that again with business failure.
Interesting. Success leading to potential failure if not managed. Okay, what about the people who actually own the business? Their view must count.
Absolutely vital. Owner-shareholder satisfaction is a key measure, and how they judge success depends entirely on their objectives. What do they want from the business?
So for big public companies like BMW in the example, it's mainly about the shareholders' return, dividends, and the share price.
That's usually the main focus, yes. The BMW example shows dividends increasing, £2.30 to £3.20, and the share price rising significantly, 55 to 80 euros, even hitting €120 before a dip. When those numbers are going up, shareholders tend to be satisfied.
Makes sense.
But for owners of private companies, maybe a sole trader or a family business, the objectives might be quite different. Survival might be number one.
Right.
Or providing a stable income. Or reaching a certain size. Success for them is meeting those specific, often personal goals.
Right. And lastly, what about the people who work there, the employees?
Employee satisfaction. Their perspective matters too. Employees have different needs and priorities from owners, don't they? They want decent wages, job security, maybe opportunities for promotion, fair treatment, a good atmosphere.
And happy employees are often more productive, less likely to leave. That sounds like success.
It often correlates, yes, but the sources add an important caveat here. High employee satisfaction doesn't automatically guarantee overall business success. Think about it. A struggling business might have to make people redundant. The remaining employees might feel very valued and secure after the layoffs, but the business itself could still be heading towards failure. So it's one piece of the puzzle, but not the whole picture.
That's a really crucial distinction. Okay, so we've got all these different ways to look at success, revenue, market share, profit, customer feelings, employee feelings, growth. How does a business actually decide then? How do they judge it overall?
This brings us to something the sources really emphasize: the importance of targets when judging success. Businesses don't just drift along hoping for success, they set specific objectives or targets.
Like measurable goals, increase profit by 10% this year, or gain 5% market share, that kind of thing.
Exactly, those kinds of things.
Yeah.
Success is ultimately best judged against whether these specific preset targets are actually met or even exceeded. Hitting targets is also a huge motivator for staff. It gets everyone pulling in the same direction.
Makes sense.
And the sources note these targets need to be realistic, achievable, and flexible too, may be adjusted if market conditions suddenly change dramatically.
So success isn't just a vague feeling. It's about hitting defined goals. And you mentioned earlier, large and small businesses might look at this slightly differently.
Just briefly, yes. Large public companies, they're under scrutiny from shareholders, the media. They tend to focus heavily on those external financial measures: profit, growth, share price, dividends. Their success is often judged very publicly on those numbers.
Whereas smaller firms,
Still care about profit and growth, of course, but often, especially if owner-managed, success might be more tied to meeting the owner's personal objectives, providing good living, ensuring security, achieving a certain lifestyle maybe. It's judged against their specific goals.
okay, got it. Before we move on to the less cheerful topic of failure, let's do a quick check.
Good idea. Quick quiz one.
All right, think back on what we just discussed. First question. Which measure looks at the total percentage of sales a business has in a specific market compared to its rivals? What's that slice of the pie called?
Is it revenue, market share, customer satisfaction, or growth?
If you were thinking about that percentage share of the total market, yeah, that's market share.
Spot on. Okay, second question. Imagine a new business owner. Their main goal is just to make sure the business brings in enough money for them to live comfortably. Besides just basic survival, what specific measure might they focus on most closely?
Think about what directly impacts their personal income from the business.
The sources link this to, well, obviously the profit generated, but also directly to whether the owner feels their objectives are being met. So profit and owner satisfaction would be really key there.
Great. Okay, so we've explored how we measure success. Now, let's look at the other side of the coin. Equally important for analysis, I think. Chapter 15, Reasons for Business Failure.
Yeah, this is a really critical chapter because, unfortunately, business failure is incredibly common. The statistics mentioned in the sources, they're quite sobering.
Like what?
Well, 58% of new businesses failed within 5 years in the UK back in 2013. And in the US in 2015, something like 400,000 businesses failed.
Wow, that's a huge number, a massive number of businesses just not making it.
It really puts the challenge into perspective, doesn't it?
Yeah.
And while there are lots of contributing factors, the sources highlight one core problem that often, sort of, triggers the final failure. Running out of cash, or not being able to raise the finance needed. Cash is king, as they say.
Right. So let's break down the main reasons the sources identify. Top of the list seems to be cash flow problems.
This is absolutely critical to grasp. A business can actually be profitable on paper. Its total income over a year is more than its total costs, but still fail. Why? Because it runs out of physical cash to pay its immediate bills. Wages, suppliers, rent. The actual money isn't flowing in fast enough.
Okay. And the sources list several specific ways this cash flow crunch happens. One is overtrading.
Yeah, this links back to that growth measure we talked about. It happens when a business tries to grow too quickly. They take on huge orders, buy loads of stock, hire lots of staff before they get paid by their customers for all that new activity.
So they spend the cash before it comes in.
Exactly. They expand beyond their immediate cash resources. It's like trying to run too fast without enough fuel in the tank.
And tying up cash in big, long-term things can also be an issue.
Definitely. Investing too much in fixed assets. Spending huge sums on buildings, machinery, fancy vehicles. That drains cash that could be used for day-to-day running costs. That money is locked up. You can't easily get it back quickly if you need it.
And selling on credit. Letting customers pay later.
That's a big one. Allowing too much credit, it's a huge cash flow risk. If you sell goods today, but let your customers wait, say, 3 months or even longer to pay, well, you have to fund all your own costs during that entire waiting period.
Ouch. I can totally see how that would leave you short very quickly. What about borrowing too much?
Overborrowing. Another common trap. Taking on too many loans, maybe to fund that rapid growth or buy those fixed assets, means you have high interest payments going out regularly. That constantly drains your cash flow, making it harder to meet other bills.
Some businesses have naturally fluctuating income too, don't they?
Yes, seasonal factors. Think about farming or tourism or maybe ice cream shops. They have peak seasons and very quiet off seasons. They need careful cash management to save money during the good times to survive the lean months. An unexpected bad season can be fatal.
And then there are the nasty surprises, things you just can't predict.
Exactly. Unexpected expenditure. A crucial machine breaks down and needs an expensive repair. You get sued. A fire or flood damages your premises. These unforeseen costs can cripple a business, especially one with limited cash reserves.
What about things completely outside the business's control, like the whole economy?
Those are external factors. A general recession means customers spend less, tastes change suddenly, maybe your product becomes unfashionable, new government regulations add costs. All these things are outside your direct control, but they can hit your cash flow hard by reducing income or increasing expenses.
And sometimes, is it just down to not managing the money well enough?
Sadly, yes. Poor financial management.
This is often down to inexperience, particularly in smaller businesses. Not keeping proper records, not chasing up debts effectively, getting customers who owe money to actually pay up, or just not planning finances properly, not forecasting cash needs. It can quickly lead to a crisis.
Okay, so cash flow problems are clearly a massive, massive category. What's the second major cause listed? Lack of finance.
This is especially tough for new businesses, for startups. They often fail simply because they can't get the funding they need in the first place, or they start with too little money. That's called being undercapitalized.
And it's harder for them to borrow because they don't have a history, a track record.
Exactly. Banks and investors see them as higher risk. So many startups fail really quickly because they literally burn through their initial investment money before they manage to start making enough sales to cover their costs and become profitable.
The sources mention the restaurant industry here. Yeah, it's a classic example. Very high failure rate for new restaurants, often because they underestimate the startup costs and just run out of cash before they build a customer base.
Okay, so cash flow issues, not enough initial funding. What else makes businesses fail?
Being competitive, not competitive. Simple as that, really. Yeah. If you can't compete effectively against other businesses in your market, you're going to struggle to survive long term.
And new companies entering the market can shake things up.
Absolutely. New entrants, they might come in with a better product, a cheaper price, a cleverer marketing campaign, and just steal your customers. The Apple versus Nokia example is a perfect illustration. Nokia was huge, but Apple came in with the iPhone and completely changed the game. Nokia didn't adapt fast enough.
And just having costs that are too high.
Yes, ineffective cost control. If your costs, wages, materials, production, overheads are significantly higher than your rivals, you can't compete on price. You either make losses or you have to charge more, and then you lose sales. It could be due to inefficiency, poor purchasing, lots of things.
So keeping a lid on costs is vital.
It really is.
Yeah.
And even if your costs are under control, if you don't tell people about your product or persuade them to buy it, that's ineffective marketing.
What does that look like?
Well, the sources mention things like launching a new product that nobody wants for hair. The Colgate toothpaste ready meal example is legendary.
Yeah, I remember hearing about that.
Or setting your prices way too high for the market. Or spending a fortune on advertising that just doesn't work, doesn't bring in customers. Or even using the wrong type of marketing, maybe sticking to expensive traditional ads when all your customers are responding to cheaper social media campaigns.
Okay, so cash, finance, competition, marketing. What else?
Something quite fundamental, like a business skills. Running a business successfully needs a really broad range of abilities, doesn't it? Leadership, negotiation, financial management, marketing know-how, people management.
Yeah, that's a lot for one person or even a small team to be good at.
It really is. And if the entrepreneur or the management team has significant gaps, maybe they're brilliant technically, but terrible with money, or great at sales but poor leaders, those weaknesses can lead to mistakes that cause the business to fail.
Which links to the next point, poor leadership.
Exactly. This is specifically about the decisions, the direction, the vision set by those at the very top. If leaders make consistently bad strategic choices, if they fail to spot crucial changes happening in the market, if they just can't adapt, it can bring the whole company down.
The BHS collapse is mentioned as an example.
Yes, often cited as a case where failures in leadership over time contributed significantly to the eventual collapse of a major retailer.
And finally, related to that idea of adapting.
Failure to innovate. In today's world, things change fast. Technology evolves, customer tastes shift, new competitors emerge, businesses that just stand still, that don't keep up, that don't develop new products or services or find better ways of doing things, they risk becoming irrelevant.
Like the BlackBerry example.
A classic case. They were dominant in the early smartphone market, but they failed to adapt quickly enough to the threat from touchscreen devices like the iPhone. They didn't innovate effectively, and their market share just collapsed.
So many interconnected reasons. It's quite daunting. Do small businesses fail for different reasons than big ones?
Well, the sources suggest the underlying causes are often the same. Cash flow problems, intense competition, poor management. These can hit businesses of any size. But large firms generally have more resources, bigger cash reserves, more assets they could sell, easier access to loans or emergency funding. They have more of a cushion.
Right.
This makes them more resilient, generally better able to survive shocks and economic downturn, a major mistake. Small firms often have much thinner margins, less cash in the bank, and find it harder to borrow. So when problems hit, they can fail much more quickly. Less room for error.
That makes a lot of sense, a smaller boat in a storm.
Exactly. Okay, let's just quickly check your understanding of these failure factors.
Quick quiz two. Right, first one. If a business is really struggling because its customers are taking, say, 3 or 4 months to pay their invoices, which specific reason for failure we discussed is this most closely related to?
Think about the cash not coming in. Is it undercapitalized, overtrading, poor leadership, or a cash flow problem caused by allowing too much credit?
If you were thinking about the delay in payments causing a cash shortage, yeah, that's a cash flow problem, specifically related to allowing too much credit.
Perfect. Second question. Imagine a popular, long-established business. Suddenly it starts losing customers really fast because a brand new company has launched a product using some revolutionary new technology that the older business just doesn't have. Which reason for failure does this best illustrate?
Think about why the customers are switching. What's the underlying issue for the older company?
This comes down to not being able to compete effectively anymore, doesn't it? So it falls under the not competitive category, and you could link it specifically to failure to innovate or maybe new entrants disrupting the market.
Excellent. Wow. Okay. We've really dug into measuring success and the many pitfalls that can lead to failure.
And what's really insightful and absolutely crucial for your AO3 analysis skills is seeing how these two chapters connect. How does actively measuring success, or maybe noticing a lack of it, help a business actually avoid failure?
This is where the analysis comes in properly. So those measures from Chapter 14, revenue, market share, profit, customer satisfaction, they aren't just like scores on a report card.
Not at all. Think of them more like the dashboard warning lights in a car.
Okay.
Falling revenue, declining market share, shrinking profits, unhappy customers complaining online. These are often the symptoms of the underlying problems we just discussed in Chapter 15. They're the warning signs.
Right. So if market share is dropping, Chapter 14 measure, the reason might be new entrants or maybe ineffective marketing, Chapter 15 reason.
Exactly. Or if profit is falling, C14, the underlying cause might be ineffective cost control, or perhaps external factors hitting sales, C14.
So by constantly monitoring those success metrics, those Chapter 14 indicators, a business gets early warning signs that something is going wrong,
Yes.
potentially pointing them towards the reasons for failure from Chapter 15 before it's too late to fix it.
Precisely. It allows them to diagnose the problem, to identify the causes of those negative trends, and hopefully take corrective action. And looking at it the other way, understanding the potential reasons for failure from Chapter 15 also helps a business set better, more relevant targets in Chapter 14.
How so?
Well, if you know that cash flow is a major risk in your industry, C15, you might set specific, measurable targets for reducing how long it takes customers to pay your debtor days, linking back to C14 target setting.
Okay, yeah, that makes sense. It's like knowing the potential diseases, the Chapter 15 risks, helps you set up the right health checks and monitoring systems, the Chapter 14 measures, to spot the symptoms early.
That's a great analogy. It really highlights the importance of proactive management, using data, understanding risks. An analysis in this context for your AO3 is about looking at the data, the measures from C14, identifying the trend, is it good or bad, explaining the likely reason behind that trend, using concepts from C15, and then discussing the potential consequences for the business.
Right, it's the what, the why, and the so what. That makes clear how it builds that analysis skill.
Exactly that.
Okay, we have covered a lot today, the many different ways to measure if a business is succeeding and the equally numerous, sometimes interconnected reasons why they might fail.
And these concepts, they really are fundamental for your IGCSE business studies. They give you the vocabulary, the frameworks you need to analyze real-world business situations effectively.
We've seen success is definitely multifaceted. It's not just about profit. And failure, while often rooted in cash problems, can stem from a whole range of strategic, operational, and external factors.
So as we wrap up this deep dive, here's a final thought for you to maybe mull over. Given those incredibly high failure rates we talked about earlier, does simply managing to keep a business going year after year, surviving the competition, avoiding those common pitfalls, does that represent a pretty significant form of success in itself, even if it's not the biggest or most profitable business on the block?
That's a really interesting question. Is survival itself a key metric of success, perhaps the most important one for many? Something to think about.
Indeed. And just one last reminder, you can find more resources and support for your studies over at www.igceast-business.weebly.com.
Thank you so much for joining us for this deep dive. We really hope this has helped clarify how businesses measure success and why sometimes they face failure.